Hi everyone. Welcome to InvosTalk Advanced Learning Series. Today we are going to learn about derivatives. What is derivative? A derivative by its very nature is a financial instrument whose value is determined by an underlying asset including stocks, bonds, or commodities. These derivatives are traded on stock exchange similar to shares. However, it's a very volatile market with high stakes involved. To make money in the derivative market, traders employ various strategies, including futures, options, and swaps. They examine market trends and use their knowledge to forecast future price movements for these assets. Trading in the derivative market, however, is not without risk. The market can be volatile and unpredictable. One wrong move can cost a trader a lot of money. However, traders can make high profits with the correct information and strategies. There are multiple types of derivative contracts. Futures contracts, options contracts, swap, forwards contracts, credit derivatives, equity derivatives, commodity derivatives. Let us now discuss the most common and useful derivative instrument, option contracts. Before discussing option contracts, let us familiarize ourselves with few common terminologies. 1. Option writer. Option writer or seller of an option is the party to the contract who sells the option to the buyer, thereby giving him an unconditional right to buy or sell the asset at a predetermined price. The option writer carries an obligation to buy or sell the asset at the predetermined price in exchange of the premium that she receives at the time of contract. 2. Option buyer. The buyer of the option carries the right to purchase or sell the asset at a predetermined price. However, the buyer is under no obligation to purchase or sell the asset, rather it is at his option to buy or sell the asset at the said price. The cost already borne by the option buyer includes the premium paid to the option seller. 3. Call option. The call option gives the option buyer a right to buy the asset at the predetermined price, also known as exercise price or strike price. In a way, the said option gives the opportunity to the holder to purchase the asset at a price lower than the market in case the price goes up. However, in case the price goes down, the holder shall not exercise the call option as the market is already offering the asset at a lower price. In that case, the loss borne by the holder shall be the premium initially paid to the option seller. 4. Put option. The put option gives the put option buyer a right to sell the asset at the predetermined price, also known as exercise price or strike price. The said option gives the opportunity to the holder to sell the asset at a price higher than the market in case the price goes down. However, in case the price goes up, the holder shall not exercise the put option as the market is already offering to buy the asset at a higher price. In that case, the loss borne by the holder shall be the premium initially paid to the option seller. Let us understand the call and put options with the help of a few examples. In the first example, let us assume that the current market price of the asset is 12. The buyer of the call option is of the opinion that the price of the asset is likely to go up. Hence, as per his expectations, he purchases the contract at a strike price of 15, thereby paying a premium of 3. Now let us say that the price goes up as per his expectations to 20. The buyer has the right to purchase the asset at the contract price of 15. Hence, the call option buyer shall exercise the said option and purchase the asset at a lower price of 15. Since he has already paid premium of 3, hence the net profit for the buyer shall be 2. Now let us assume that the price of the said asset goes up to 14 but stays below the contract price of 15. In such a case, the asset is available in the market at 14, and as per the contract the asset is available for 15, hence it would be beneficial to purchase the asset from the market. Therefore, the option holder shall not avail the option, rather purchase the asset from the market. The net loss in this case shall be premium borne of 3. The buyer will only exercise the option if the market price goes higher than 15. The maximum loss that the buyer shall bear will be of 3 only. Let us consider similar example for put option. Let us assume that the current market price of the asset is 18. The buyer of the put option is of the opinion that the price of the asset is likely to go down. Hence, as per his expectations, he purchases the contract at a strike price of 16, thereby paying a premium of 2. Now let us say that the price goes down as per his expectations to 10. The buyer has the right to sell the asset at the contract price of 16. Hence, the put option buyer shall exercise the said option and sell the asset at a higher price of 16. Since he has already paid premium of 2, the net profit for the buyer shall be 4. Now let us assume that the price of the said asset goes down to 17 but stays above the contract price of 16. In such a case, the asset can be sold in the market at 17, and as per the contract the asset can be sold for 16, hence it would be beneficial to sell the asset in the market. Therefore, the put option holder shall not avail the option, rather sell the asset in the market. The net loss in this case shall be premium borne of 2. The put option buyer will only exercise the option to sell if the market price goes lower than 16. The maximum loss that the put option buyer shall bear will be of 2 only. The derivative market is a dynamic and exciting world with numerous opportunities for those with the necessary skills and knowledge. If you are willing to take up the challenge, we are here to guide you on this journey through the derivatives market. For more information, visit us at our official channels. InvosWealth.com. Follow us on Instagram at InvosWealth. For more such videos, subscribe our YouTube channel youtube.com/@InvosWealth.